Hi everyone, mutual funds are the best for long-term investing, but they're equally good for your short-term investing needs, such as, for example, you have 10 lakh rupees ready to make the down payment of your dream house, which can happen anytime in the next 3 months. Or for that matter, you have 8 lakh rupees ready for your wedding expenses that is fixed for 5 months from now. In such circumstances, one option is you can park this money in a fixed deposit, which is going to give you roughly 3 to 4.75% return, or you can invest this money in either liquid mutual funds or ultra short-term mutual funds that are likely to give you 6 to 7% return when I'm recording this video with almost zero risk. So in this video, we are going to compare liquid mutual funds, ultra short-term mutual funds, and more importantly, when to use liquid mutual funds, when to use ultra short-term mutual funds with practical life examples. It is going to be super interesting video. Only humble request I have is watch it without skipping. There is ton of learning coming in this video. With that, let's get this video started. Let's first understand the difference between liquid mutual fund and ultra short-term mutual funds. So liquid mutual funds invest in debt instruments such as T-bills, commercial papers, etc., which mature within up to 90 days. While ultra short-term mutual funds invest in debt instruments such as T-bills, commercial papers, etc., which mature within up to 180 days. So the only difference between these two is that liquid mutual funds invest in instruments that mature within 90 days, while ultra short-term invest in those instruments which mature within 180 days. So longer duration is what ultra short-term mutual funds hold for. The first thing we are going to do is learn about return differences between liquid mutual fund and ultra short-term mutual fund. Before that, have a look at this screen here. I am opening up ICICI fixed deposit rates for the short-term fixed deposits. What you will see very clearly is the FD rates right now up to 180 days, which is up to 6 months of investment, is going to give you roughly 3 to 4.75% right now. And that is too less a return from my perspective because inflation is even more than 5% right now. So we are going to lose our money if we invest our money in fixed deposit. Of course, it comes with assured returns. But now let me show you liquid mutual funds. So have a look at liquid mutual funds. I have listed down all the liquid mutual funds here and you will see the average YTM. Please understand, in cases of liquid mutual funds, we do not consider CAGR. We do not give that much importance to CAGR, which is the compounded annual growth rate. What we do is look at the average YTM. Now, what is average YTM? Please understand, very, very important concept that you need to know. Not only for these two mutual funds, but for every debt mutual fund that you will ever invest in, right? What is average YTM? Average YTM is if this liquid mutual fund, let us say Quant Liquid Plan here, have, let us say, invested in 50 bonds, T-bills, certificate of deposits, commercial papers, and other debt instruments. And if Quant Liquid Plan, for example, stop putting fresh money into the portfolio and let the portfolio mature, there will be various maturity periods like 3 months, 6 months. In case of liquid mutual funds, they invest their money into debt instruments which mature within 91 days, right? If all those instruments get matured in the 90 days or 95 days or whatever is the maturity period, how much of return that entire portfolio is going to give you is what is average YTM, right? Right now you can see liquid mutual funds average YTM is roughly 7%, close to 7%. If you go down, you can have a look at it. Around 7% is what is likely to give you, which is almost double than the fixed deposit returns. Please understand, this return is only at the time of recording this video. It might change when you're watching this video, right? Let us now move to the ultra short-term mutual funds. I filtered ultra short-term mutual funds, roughly 25 here. If you look at the average YTM of ultra short-term mutual funds, you will see that it is slightly better than liquid mutual funds, roughly 7.57, 7.62. You are likely to get 0.30% more than the liquid mutual funds right now. I also want to explain to you that in the coming 12 months, ultra short-term mutual funds are likely to give you better returns than liquid mutual funds. Let us learn that with an example. If I show you UTI Liquid Cash Fund, which is a liquid mutual fund, have a look at something called as modified duration. Very, very important concept again. Simply meaning that, let us say tomorrow, if RBI repo rate goes down by 1%, it is going to give you 0.11% better returns, right? While in case of ultra short duration funds, if you look at example modified duration, you are likely to see that the modified duration is going to be slightly higher, meaning that tomorrow if the RBI repo rate goes down by 1%, you are going to get 0.36% better returns in case of ultra short-term mutual funds. I know right now the RBI repo rates are all-time high. In the next 12 months, they are going to fall down. Therefore, ultra short-term mutual funds because their modified duration is higher than the liquid mutual funds, they are going to give you better returns. So this is the story about returns. Liquid mutual funds are slightly giving less returns right now, while ultra short term mutual funds are likely to give you better returns. But please, before you make any decisions, also watch about risk and volatility, and also when to use these two instruments, because it depends on your needs. Now the natural question that if liquid mutual funds and ultra short term mutual funds are giving better returns than fixed deposit, what is the risk that is involved? What is going to happen if I invest in these two funds, right? For that, what we are going to do is have a look at the portfolio, and let me clarify, the risk is almost zero. It's not zero, but it is almost zero. So if you look at Bank of India ultra short duration fund here as an example, you will see that their top holdings, if you look at it, they are investing in T-bills, certificate of deposits, debentures and things like that, which are all either AAA rating, which is the highest rating, or they are given to government, SOV means sovereign, which is in government, or A1 plus. Majority of these debt mutual funds are not going to default, therefore the risk is minimum. But let me show you the fluctuation in their returns. So if you look at the UTI liquid mutual fund here as an example, you will see that from June 20 onwards, the blue bars that you see is the liquid mutual fund return given by UTI. So if you look at it in June 20, from June 20 onwards, the returns have been steadily going up. If you see the blue bar, right now it is giving 1.71% quarterly. So if you multiply it by 4, you're going to get roughly 6.5, right? Now you see why this is happening, because of RBI repo rate. As soon as the RBI repo rate started to going up, liquid mutual funds started to give better returns because debt instruments have become better. This is likely to continue in 2023 at least. But again, your risk is that if the RBI repo rate changes, your returns are likely to change. Now let us compare the volatility risk between both liquid mutual fund and ultra short term mutual fund. For that, we are going to jump back to the ticker tape, and you will see that volatility here is 0.1, roughly 0.15, 0.10, 0.12 in case of liquid mutual funds. But if you look at ultra short term mutual funds, you're likely to see that volatility is slightly higher, 0.32, 0.35, because ultra short term mutual funds invest for roughly 6 months, up to 6 months, while liquid mutual funds are even shorter duration. So volatility is going to be lesser. So if you want more assured returns, then liquid mutual fund is way to go. While if you want less assured returns, then ultra short term mutual fund with higher returns is what you're likely to go. Let us quickly also compare the exit load as well as the expense ratio of both of them. If you look at the liquid mutual fund, the expense ratio is roughly 0.20, 0.17, so it is on the lower side. But if you look at the expense ratio of ultra short term duration funds, you are likely to see expense ratio of like 0.4, 0.35, so it is slightly more in case of ultra short term mutual funds. If we look at the exit load, you will see that ultra short term mutual funds typically either will have no exit load, or if some mutual funds have exit load, it is likely to be higher, 0.50. While in case of liquid mutual fund, the exit load is going to be very low, very low. In fact, if you invest for more than 7 days, you don't need to pay any exit load in case of liquid mutual funds. Lastly, if we compare the capital gain tax, very simple, both the mutual funds are debt mutual funds. Right now, the debt mutual fund taxation is very simple. You have to pay tax on the capital gain as per your income tax slab, whether you hold them for shorter duration or longer duration. Now let us talk about practical examples of when to use liquid mutual funds, when to use ultra short term mutual funds. The first life example or scenario is emergency fund. If you're building your emergency fund, I would highly recommend for you to use liquid mutual funds, not ultra short term mutual funds. Primary reason is in liquid mutual funds, you can get instant redemption of your money. Some mutual funds are even giving you 30 minutes money quickly, so that you can withdraw your money very quickly in the cases of emergencies. While in ultra short term mutual fund, it will take at least 1 working day for you to get your money back. So for emergency purposes, please consider liquid mutual funds. I've created a full video on explaining which liquid mutual funds are best and how to go about selecting the right liquid mutual funds for your investment. Example number 2 is, let us say you're saving for your wedding expenses, and let us say your wedding is coming in the next 3 months, 90 days, then go for liquid mutual funds. If your wedding is fixed in the next 5 to 6 months, then go for ultra short term mutual funds, because you know that your date is fixed. You need your money at that particular point in time, not right now. Example number 3 is, let us say you're saving for your house or your flat's down payment, because it's an uncertain situation. You don't know when you are likely to get a good house or good flat for your needs. Go for liquid mutual funds, because up to 90 days they are the best for your investment. You do not know when you are likely to redeem your money. Go for liquid mutual funds. Last example I'm going to take is cars down payment or saving money for cars investment. Then in that case, what you need to do is look at your ultra short term mutual fund investment strategy, because you can always plan your car so that you can get more returns out of ultra short term mutual funds with less risk. I hope you enjoyed this video thoroughly. If you did, please press the like button, and you can follow me for upcoming videos. Until then, keep rocking.